Good morning and welcome to Retire Smart Austin. My name is Cynthia DeFazio and I am joined today by Philip Donato Capriati, Sr. He is President and CEO of Donato Wealth Management and Senior Tax and Insurance Advisors. It's a lot to say, Philip.
It is a lot to say. Good morning, Cynthia. It's a pleasure to see you today.
It's such a pleasure to be with you today. And I know that you've been so busy. We were talking as the credits were rolling actually to open the show that your new radio program has really taken off. Can you tell the viewing audience about that as well?
Yes, so we started Sunday mornings on KLBJ, so you can tune in from 7:30 to 8. We answer a lot of questions from the viewing audience, basically about tax planning, Social Security, retirement income planning, a lot of different facets. What do we do for our clients in our practice? So it's a myriad of topics and information, so please feel free to tune in 7:30 to 8 a.m. every Sunday morning on KLBJ.
That's amazing, Philip. I know because you've been so busy. The shows themselves have really been, having a lot of callers call in with some amazing questions. What has the feedback been like from the viewing audience?
It's been a lot of fun. So the really unique thing is that folks are really listening, because some of the questions that come in are even more detailed than the actual topic. So they're digging in. When they come into the office, they're loaded with questions.
Yeah.
What we find, most of the folks that tune in, their primary concern are taxes and retirement. That's a number one concern. How to get to a tax-free or tax-efficient retirement, which of course we specialize in. And basically Social Security, when to take, why to take it early or late, how does it fit into their retirement income plan, and what's really works best for them and their families. So every individual is different. So every plan is different. So when folks come into the office, they'll speak with Gregory. Gregory is our Social Security specialist. He's done thousands of Social Security plans, written plans. So every strategy, they're not one-word answers. So when an individual asks a question, it depends on their situation. So there can be a dozen or 24 different answers to the same question based on the individual's specific circumstance.
Absolutely. Well, Philip, I think a lot of our show today should be actually encapsulating a lot of the viewer questions that we've gleaned through the weeks, because we don't often get a chance to get to each and every caller when they're calling in.
Sure.
So if you don't mind, I'd love to ask you a few questions from the viewing audience. Is that okay?
Go ahead and shoot.
All right, good.
Let's do it.
So your first caller is Katie from Round Rock. She would like to know the advice on taxes and Social Security benefit. What kind of advice can you give her on taxes?
Okay, so Katie, that's a great question. So when we talk about taxation on Social Security, we have to understand that at most under the current tax law, up to 85% of your Social Security benefits can be considered or added in as taxable income. Not taxed at 85%, but 85% of your Social Security. So if you receive $30,000 in Social Security, up to 85% of that $30,000 can be added in as taxable income.
Okay.
So Katie, it's based on a provisional income formula that was set up back in the 80s with President Reagan and Tip O'Neill. So every year when we do the taxes based on the provisional income, which I'll explain in a second, your Social Security can be taxed at either 0% or 85% of it can be taxed at whatever your current tax bracket is. So it's extremely important when you're structuring a tax-efficient retirement income plan. The first thing we want to do is we want to maximize Social Security. The second thing that we want to look at and prioritize is reducing the taxes on Social Security. So let me give you an example. What is the provisional income formula? Well, you take half of your Social Security benefit, that will go into the provisional income. So let's say you're getting $40,000 in Social Security, only $20,000 of that will be considered as part of the provisional income.
Okay.
Any of your RMDs, your required minimum distributions from your IRA, will also go into that. Tax-free municipal bonds, they're tax-free, but not when it comes to the provisional income. That'll be added in. Any other income, pensions, dividends, interest, all gets added in to the provisional income formula to determine how much of your Social Security is going to be taxable income. So the better question would be, what does not go into the provisional income? What does not count against my Social Security being taxed? Next week, we're going to be doing a show on using the tax code, using IRS code 7702, which is basically certain types of life insurance policies or contracts taking withdrawals. None of those withdrawals are considered taxable income. They don't go into your provisional income formula. None of any Roth distributions, when you take distributions from the Roth, that's not considered in the provisional income. So when we structure a tax-efficient retirement income plan, we want to look at maximizing the Social Security benefit. And then we want to look at taking income from sources that do not increase that provisional income. If you can keep that provisional income under $32,000 per year, not your income, but your provisional income under $32,000, none of your Social Security is taxable. So when you, what I would recommend is you call into the office, tell them you saw the program, and tell them that you want to talk about how can I get my Social Security, how can I provide for a tax-efficient Social Security benefit. And we'll take a look at it and we'll see what we can do. So this is our specialty. And my thought is we spend 30, 40, 50 years paying into Social Security. I really don't think it's fair that anyone should be taxed on Social Security benefits. However, if their advisors are not helping them, or even their CPAs are not talking about these things, they need to talk about it, because it's not so much how much you receive, but how much do you get to actually keep. So we want a tax-efficient retirement income plan, and we want to make sure that that Social Security is coming to them preferably tax-free, but at the very most, we want to pay the least amount of taxes on Social Security. I have software in our office. It's proprietary software. We can sit down and actually do a Q&A and show you more specifically how does it work, how do I get to a tax-efficient retirement income plan, how do I get my Social Security, how do I structure my income so my Social Security is either tax-free or tax-efficient.
And Philip, would they need to bring in their Social Security statements when they sit with you? Is that how that would help facilitate the process?
So initially what they'll do is we'll make an appointment, call our office, make an appointment, call 888-818-6557. There's no charge for this. These are complimentary consultations every show for our first 10 callers, and let them know that they want to talk about Social Security and a tax-efficient retirement income plan. They want tax-efficient Social Security, and they want a tax-efficient retirement income plan. Even if their current plan is not tax-efficient now, if you're noticing that you're paying more taxes now than you have in the past, we can actually put a plan together to help you reduce that going forward. Every dollar you pay to the government is a dollar that doesn't come back.
Absolutely. Well, Philip, we're going to open up those phone lines to the viewing audience at home. That number to call once again is 888-818-6557. For the first 10 callers this morning, you will have the opportunity to have a consultation with Philip within the office. Again, that number to call is 888-818-6557. We'll be right back after this very short commercial break.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have. by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no-obligation, full-blown financial review today.
And welcome back to Retire Smart Austin. My name is Cynthia DeFazio. I'm joined today by Philip Donato Capriati Sr. He's President and CEO of Donato Wealth Management, Senior Tax and Insurance Advisors. Philip, another great show, and I love how we're starting this week with the viewer questions because it's so important to, pay attention to those questions that come in. You do such a great job of that, but there are some that we just didn't get a chance to address.
Thank you.
So we're going to jump into the next one just in the effort to save time. We have a caller. It's Greg from Cedar Park. How do I construct a written retirement income plan? Philip, any light you can shed would be much appreciated.
So that's also a very good question. So with a retirement income plan, many financial advisors and even accountants, depending on the individual, they really don't put together a written plan and then adjust it. In other words, make changes.
Okay.
Things change. Like, for instance, in February, March of this year, the market, we had the COVID crash, you might want to call it, or the COVID correction. That has to be incorporated into the plan. If you had an advisory firm where your portfolio lost 20, 25, 30%, number one, that's too much volatility, but the plan now has to be readjusted. So when we meet with a client, every single review, we sit down and we update their written retirement income plan. So the first thing we want to look at is we want to look at a goal retirement income after taxes, net of taxes. So I'll ask a client, how much are you spending? So we'll actually go through a spreadsheet. Let's put it together. What is your mortgage if you have any? Most of our clients' mortgages are maybe paid off. What is your age? What do you spend your money on? How much do you spend on vacations and things of that nature? So what we want to do is we want to look at what's their goal retirement income, what's their current tax bracket. We want to adjust the retirement income for inflation each year.
Okay.
And then we want to look at sources of income. We want to sit and look at all of their accounts. So when I say accounts, what are my sources of income? How much, and if I'm married, how much is my spouse and I receiving from Social Security? How much are we taking or receiving if we're fortunate enough to have a pension, state, government pension, federal pension, or even a private pension? How much will I receive from rental income if I have it? So we want to look at all of these different income sources. We want to take the net of those income sources, net of taxes, and then look at the difference between what their goal retirement income is and what they're actually receiving, what I call mailbox money. Social Security is the foundation of your mailbox money.
Sure.
Now, the next thing we want to do in a written retirement income plan is I want to take a look at, okay, how do I take, let's say I need an extra $20,000 to meet my annual goal. What accounts do I want to take it from to keep my retirement income plan tax efficient? Do I want to take it from the IRA? Do I want to take it from dividends? Do I want to take it from a life insurance? Do I want to take it from a Roth? So when you structure a tax efficient retirement income plan, this is what we want to look at.
Okay.
So with our clients, we start off with their Social Security, and then we move directly to their retirement income plan, where we structure Social Security, pensions, other income, and then we go to work and we cook up a tax efficient retirement income plan.
Okay.
If I take X amount of money from my IRA, how does that cause my Social Security to be taxed? So we want to take a look at that. So
Sure.
for Greg out in Cedar Park, a written retirement income plan should be it should be done with a professional. It should be in writing. It should look at taxes, inflation, what sources of income do I want to draw from, and what sources of income do I want to draw from to keep my Social Security either tax-free or tax-efficient. And again, remember, at the end of the day, for most of us in retirement or approaching retirement, we've paid taxes on our income for 30, 40, 50 years. The very last thing we want to do is see our taxes double and possibly triple because we're not structuring a tax-efficient retirement income plan.
Sure.
Come into our office, we'll show you how it works. And once you get on that track, once you get that system in place and you understand it, okay, it's easy to keep it up. We want to do it yearly. Sometimes we have clients come in twice a year. I want to take a look. This has changed. Can we redo my retirement income plan? And so if your advisor is not doing that, they should be doing that. Give us a call. Come in for a complimentary retirement income plan consultation, and we'll take a look at it and we'll counsel you.
And Philip, let me ask you, in your opinion, how important is it to have taxation factored into your retirement plan? Because I think a lot of people probably forget to take that step because it's something that you typically don't think about. A lot of people assume taxes will go down in retirement.
Most financial advisors simply aren't tax specialists, okay? They're not, they just aren't. And many of them are afraid to talk about taxes.
Okay.
Many of them, their advisory firms won't allow them to talk about taxes. So we're a tax firm first and an investment advisory firm second.
Okay.
So when I started this company in 2005, the goal was simple. How do I get retirees to the lowest possible tax bracket in retirement?
Perfect.
Not just today. How do I structure these retirement savings accounts?
Yeah.
And so it all fits. It all falls into place. But if you're not careful and you do not have expert guidance on where to take the money, what happens is at the end of the year, you're going to get a surprise. I'll have folks come in and say, I'm working with advisor ABC from this particular firm, and my husband passed away and nobody talked to me about taxes. Now I'm single, filing single, and my taxes doubled. How did that happen, Philip? So this is part of an ongoing update with your retirement income plan and your tax plan. One should fit into the other. Now, if you believe that taxes are going down in the future, or you believe that you didn't pay enough taxes while you were working, and you don't mind paying additional taxes as our debt continues to grow and loom,
right,
then you don't really need to come into the office. But if you're concerned, if you think you have a tax problem, because maybe you have too much money in it's a good problem to have, too much money in your 401k or IRA, come in and let's talk about how to make adjustments, how to shuffle money into different accounts to make it tax efficient.
Okay. Well, Phil, we're about ready to open up the phone lines for the second time this week. What can you tell the viewing audience they can expect to receive by being one of your first 10 callers?
When you come into the office, what you can expect is number one, to be greeted by a very friendly staff, very knowledgeable staff, and every consultation that we extend are complimentary. Many advisors nowadays do not want to prove to their clients what they can do. They expect everything to happen today, and they expect it to, they expect them to move efficiently and to move immediately. We don't do that. So when you come in, the very first thing we want to do is we want to teach you. So we want to educate you. We want to look at your current plan. We want to structure it in a tax-efficient manner. And if you do have a potential tax problem, we're going to address it. We're not going to run from it. So they can expect a Social Security maximization report if they have not already filed for Social Security. They can expect a written retirement income plan, including an RMD distribution report. The third thing that we provide to all of our clients is an institutional Morningstar investment review. We want to take those portfolios. We want to run our home office runs a Morningstar report with an executive summary. It's important to understand what's your portfolio, how much risk is in it. We want to know how much your portfolio is actually returning, and what are those internal and external fees. All of this data fits into that tax-efficient retirement income plan. All three reports, it's our pleasure to provide this level of education and this level of service to each and every caller that watches our show.
For the first 10 callers today?
For the first 10 callers today.
That's amazing. To the viewing audience at home, that number to call once again is 888-818-6557. We know you have a lot of questions about planning your perfect, comfortable retirement. Philip has the answers for you. Once again, we have to take a very short commercial break, but when we come back, we're going to have more questions and answers about planning your perfect retirement. Please stay tuned.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
And welcome back to Retire Smart Austin. My name is Cynthia DeFazio. I'm joined today by Philip Donato Capriotti Sr. He's president and CEO of Donato Wealth Management and Senior Tax and Insurance Advisors. Phil, a great show, and I can't believe that we got through just a couple of questions because we have so many more to get through. But I'm just going to jump right into the next one just in an effort to save time.
Okay.
Okay. So we have a caller. It's Mary from Marble Falls. And she said, Philip, I have a question for you. What is the difference between a Roth conversion and a Roth contribution? I am confused by these terms.
Okay. All right, great. So first of all, a Roth IRA is a tax-free retirement account, probably one of the most important accounts that anyone can have in retirement. The way a Roth contribution works is you have to have earned income. Either you have to have a W-2 paying job or net 1099. So it has to be earned income. Can't have pension income, can't have passive income, rental income. Has to be earned income.
Okay.
The way the Roth contribution works is if you have earned income and you're under the limit, which is just about $200,000 a year. If you're making under that $200,000 a year, you can contribute to a Roth IRA. If you're working for a company, that limit, if you're 50 and over, is $7,000 per year.
Okay.
$6,000 max plus $1,000 per year catch up. If you work for a company and you have a 401k, pay very close attention here, you can contribute up to $25,000 in a Roth 401k.
Okay.
Many of the companies nowadays are allowing for a traditional 401k and a Roth 401k. One of the benefits of that contribution is that you can contribute up to $25,000, as I said before. What are the benefits of it? Well, first of all, back in 1998, I think it was, Senator Bill Roth came up with the idea of a tax-free retirement plan for certain folks. That's the Roth IRA. The idea behind the Roth IRA and the contribution is I can contribute money into the Roth IRA if certain income limits are met. And that money I pay tax on the seed and not the crop.
Okay.
So in other words, I pay taxes once on the contribution. Now that contribution can sit and grow tax-free for my lifetime, if I'm married, my wife's lifetime, my children and grandchildren. It's multi-generational for up to 10 years of their lifetime.
Okay.
So it's tax-free accumulation. It's extremely important to have a Roth IRA in retirement if you want to put together a plan to get your Social Security tax-free or tax-efficient. Now, that's a Roth IRA or Roth 401k contribution. A Roth conversion in 2010, our elected officials, they actually agreed on something amazing back then, and they actually agreed on the fact that they wanted to, and the story went that we had such excessive debt. They needed to pay down the debt, and they were going to allow folks who had an IRA or a 401k to move it or convert it over to a Roth IRA. So this is where we do not need earned income with a Roth conversion.
Okay.
We do not have an age limit. I have folks that are in their 80s that do Roth conversions, and we do not have an income limit. So there's no income limit to do a Roth conversion. There's no age limit to do a Roth conversion. There's no restrictions at all, except that you have to have an IRA or 401k.
Okay.
So the contribution while you're working, the conversion is something you do whether you're working or not. So many of our clients will come in and they'll say, how do you help folks convert to a Roth? So again, in our retirement income planning software, we have a proprietary Roth conversion software.
Okay.
When we provide our clients with tax services, because we have a very robust tax practice, each year we'll sit down, we'll do a tax review, and we'll do a Roth conversion review.
Okay.
So we'll want to look at how much did I earn? How much is my Social Security? What is my pension? And then our software will allow us to determine or help a client determine how much can I convert to the Roth this year at the lowest tax bracket? And we'll sit and have that conversation. Once it's in the Roth, even if it's a conversion, that money sits and grows tax-free for your lifetime, if you're married, your spouse's lifetime, as well as with the new tax law, up to 10 years of your dependent or inherited IRA's lifetime. Really important to have 3 separate accounts.
Okay.
Taxable accounts, but my favorite is tax-free. And tax-free is the Roth contribution or the Roth conversion. If you do not have a Roth, come into our office, call 888-818-6447, and tell our staff that you want to come in and talk about how to execute a properly planned Roth conversion strategy.
Absolutely. And is that an easy conversion, in your opinion,
In
Philip?
my opinion, it's very easy. It's like anything. Knowledge is power.
Absolutely.
Okay? And once we arm you with the knowledge, it will be very easy and easy to understand. It should be done yearly, and we could do it, and we can do Roth conversions 1 year, 3 years, 5 years, 10 years out, as long as the tax code allows us.
Philip, thank you so much. Always a pleasure.
Thank
to
you,
our
Cynthia.
viewing audience at home, thank you so much for spending time with us again this week. We appreciate it so much. We look forward to seeing you here next week. We hope that you have a blessed, safe, happy, and healthy week ahead. Thank you again for watching. We appreciate your time. Take care and God bless.